Hello and welcome to the Morningstar series Market Reaction. I'm Emma Wall and joining me today is Rathbones' Ed Smith to talk about the budget. Hi Ed.
Hello Emma.
So of course, like any Chancellor, Philip Hammond yesterday tried to deliver a positive message about the UK, saying that he was going to build a Britain fit for the future. But hidden in a lot of his positive rhetoric was the fact that the economic outlook for the UK has been significantly downgraded.
For sure, and downgraded to really quite a large extent. This is the first time since the Office for Budgetary Responsibility started doing the forecasts that growth is expected to be below 2% in every single one of the 5 years forecast. It's expected to average just 1.4% over the 5 years, and that puts UK growth right at the bottom end of the spectrum when we look at expected growth across advanced economies.
I suppose this is a very simple question and there may not be a very simple answer, but why the downgrade? Why does the outlook for the UK economy now look worse than it did a year ago?
It's largely to do with the outlook for productivity. So, like pretty much any forecaster, the OBR over the last 7 years has forecast productivity to return to around about the 2% trend sort of 3 years out. But UK productivity and productivity globally, actually, the UK is not unique in this. Productivity has disappointed time after time, quarter after quarter. And in fact, actually this year, productivity growth in the UK is likely to be negative, which is a really dire outcome for an advanced economy, which relies on productivity to really grow because demographics aren't with us and we've got plenty of debt.
So a downgrade in economic outlook, a downgrade in productivity. There was some, I suppose, good news in the fact that Philip Hammond expects our debt to GDP to peak before waning next year, peak at 90%. Now, that doesn't sound like too much to boast about, 90% debt to GDP, but it is lower than some of our peers, although it is higher than the European recommendations for debt to GDP, isn't it?
Yeah, I mean, 90% would still place us probably second or third, will probably give us the second or third lowest debt to GDP ratio in the G7 economies. The US, over the forecast period, will probably get up to between 120 to 130% of GDP. Japan, obviously, in the 200s almost now. So I think it's really not something to boast about because the Conservative government or the coalition government originally thought debt was going to peak some years ago, in the middle of this decade. And they've consistently missed those targets. And I think and the main reason why they've consistently missed those targets is because of growth. And of course, the downgrades today are compounding that.
This seems like a very gloomy chat. We've talked about negative productivity growth, negative economic growth, or at least, downgraded economic growth. And now we're hearing that actually the debt forecast may not even be true either. Is there anything to be cheery about?
Well, I think what's important to take away is that it's low growth, not recession. We're talking in very gloomy terms, and often when we're talking gloomy terms, we're predicting a recession, which usually means a bear market for investors. We're not saying that. The good news is that a lot of the gloomy expectations are already baked into things like the sterling exchange rates. We think the actual exchange rate is as cheap relative to the economic fundamentals that drive exchange rates over the long term as we've ever seen over the last 35 years. So a lot of this gloomy picture is baked in. We're not facing a big sort of cliff edge in some domestic investments. In the budget, there were some positive things, but they were all relatively small. So it's great that we're seeing an increase in the tax credit for research and development. That's really important to attract business investment, particularly in the Brexit environment, because we know that a lot of business investment is intended to be allocated towards R&D over the next few years.
Ed, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.